welcome Humboldt County employees. My name is Megan Harris, and I want to welcome you all to the Assist to Own Down Payment Assistance Program provided by GSFA. I'm joined with Nathan McGraw today from Change Mortgage, who's one of our outstanding participating lenders. He has a lot of background and experience with this program and will be happy to answer any of your questions specific to your particular situation. He'll also make his contact information available to you so that you can reach out after the training and get support that way as well. The reason Nathan's presence is important here today is because the way to access this program is through one of our participating lenders. They take you through the entire process. It can help you understand the guidelines and options available under the program specific to your scenario, and will help you make the decisions that are going to be best for you and your family. So with that said, again, I want to welcome you all. Let's go ahead and get started. I do want to let everyone know this is going to be a general overview of the program, basically giving highlights and basic general guidelines, right? So that you have an idea of how the program works. But Nathan and our other participating lenders available on our website are going to be the resources that you want to reach out to actually get started. They're going to be the ones to quote interest rates and APRs, and again, address those specific details according to your individual scenario. So a little background on GSFA. We are a housing finance agency, and our mission is to provide access to affordable homeownership opportunities for Californians. And this is something we've been doing for over 33 years now. And so far, we provided over $683 million in down payment assistance to over 87,000 home buyers to date. And when it comes to California, we have a unique mix of circumstances here between the economic conditions, right? We've all been, subject to these higher gas prices that are going on, right? We've got interest rates, we've got home inventory concerns, and then of course the price of homes these days, depending on where you're purchasing. So all of those factors can kind of lead to some hesitation when it comes to buying a home. And I think everyone is going to have a different reason for whether they're ready to buy a home or not, right? And we'll talk more on that, but I want to just point out the benefits of home ownership and the reason why GSFA champions these programs to help people become homeowners, right? So home ownership has been proven to have a positive impact on families and communities by improving stability in neighborhoods, educational achievement, civic engagement, and even improving the physical and psychological health of the homeowners and just the population at large, right? And it can even contribute to a correlation in crime reduction. If you think about it, if the vast majority of the people in your neighborhood own the home, they're more likely to care, right? Because they have a tangible investment in that community. And, let's be honest, it takes a little bit of skin in the game these days and just in life in general for people to care and put effort and time and consideration into their property as well as their neighbors. So we want to make sure everyone's clear that, it's more than just the American dream, right? It's a reality that homeownership has a quality of life benefit. And we can't overlook the financial component there either, right? If we have a conversation about net worth, more than likely real estate is going to be in that conversation. And according to the National Association of Realtors and the 2022 survey of consumer finances from the Federal Reserve, the average homeowner has a net worth that of 38 times more than a non-homeowner. So if we were to put that into dollars and cents, the median homeowner has a net worth of approximately $396,000, whereas a non-homeowner has a net worth somewhere in the neighborhood of $10,000, right? So big difference there. And we want to be a part of the difference that you make as a result of your homeownership journey. So again, coming back to barriers to home ownership, there's going to be a lot of reasons why people aren't in a position or they feel like they're not in a position to buy a home just yet. Again, those reasons are going to be nuanced and varied, but when it comes down to it, the vast majority of people who don't feel ready to buy a home right now are actually paying a mortgage-sized rent, right? And so the reality is that they just can't afford that initial investment, right? The down payment, the closing costs that come after the down payment is made. And so that's where this program comes into play. So the GSFA Assist to Own program for Humboldt County employees is going to provide up to 5.5% in down payment and closing cost assistance. And qualifying is easy. You already meet the minimum requirement, which is being a Humboldt County employee. And this is available to 39 other counties in California for county employees specifically. So if you have any friends or family members, associates, etc., and any of the other 39 counties that are eligible for this program, and again, they are also county workers, then it might be a good idea to share this program information with them as well. You don't have to be a first-time home buyer. Even if you already own a home and you're maybe looking to change primary residences, or maybe you have a rental property, you can still qualify for this program. You also don't have to have perfect credit. And not only that, even though you do have to be a Humboldt County employee in order to benefit from this program, you can actually purchase or refinance an existing primary residence anywhere in the state of California. So lots of flexibility there. Now, really quick, I just want to point out the difference, right? If we can put this into dollars and cents, what it looks like in terms of the difference the program makes. Okay, so the median home price in Humboldt County right now is $415,000. Now, I don't live in Humboldt County, so I'm not sure if those numbers are accurate. That's what Google says, so that's what we're going to go with for this example. Now, $415,000, right? If you were to use an FHA loan, which requires a 3.5% down payment, that would mean you need to come in with at least $14,525 in this case, okay? And the balance of your loan amount would be $407,483. This is the mortgage loan amount that you would be paying back over time, including the upfront mortgage insurance premium added to that. And those are all details Nate and other participating lenders we have available can explain to you. But back to the main point, if you were to get assistance from our program equal to at least up to 5.5%, you would receive 5.5% of this figure, right? So whatever your total loan amount is, you would get up to 5.5% of that. In this case, at 5.5%, that works out to $22,411, which is enough to cover your entire down payment required, right? And leave you with money left over for closing costs. And closing costs are some of those sneaky expenses that not a lot of people are aware of when it comes to buying a home. There are additional expenses that are ordinary and customary when it comes to buying a home on top of your down payment. So having that extra reserve there for that money can be critical for a lot of people in a lot of situations. So as I mentioned before, we have a lot of flexibility with our programs. We provide you with the assistance. It allows you to apply the funds in the way that makes the most sense for your transaction, right? So whether that's down payment, closing costs, a combination thereof, or if you want to pay down some of that principal balance on your first mortgage loan, so you're spending less money over time, that's an option as well. Also, there's no minimum or maximum investment on your part, right? So there's no minimum or maximum contribution you need to make in order to be eligible to receive this assistance. So if you do have your own cash already that you've been saving up, you're welcome to combine that with our assistance, as well as any gift funds rather from a friend or a family. Actually, it's really family, right? So family is going to be the eligible source that you would be able to receive a gift from, as well as any other institution that is not going to encumber the property with another lien, right? So another grant or some other program that you may have access to that doesn't deed restrict the property or result in another lien. So we have an example here to kind of show what it could look like if you were to pool funds, right? So you have your own funds, you get a gift from family, then you have your own cash, right? And the assistance from the program. And let's say you decide to use all of it as a down payment. your sales price started at 415, but you're only going to be paying back 377, 589 at that point, right? And so that's again going to make a difference in how much you spend over time. So getting into the details of the structure of the assistance, the amount, the terms, etc. So the primary assistance you'll receive is going to be a 3.5% first mortgage loan. I'm sorry, it's going to be equal to 3.5% of your first mortgage loan. Okay, and then on top of that, what you want to know about that second mortgage is that it's going to be by the way, if I didn't mention this, the assistance will be provided to you as a second mortgage, okay? And so that second mortgage will be a deferred second mortgage. So that means there's no monthly payments, there's no interest rate, so therefore no interest will accrue on that second, and you'll simply repay it whenever you sell your property, whenever you refinance, or in 30 years, whichever comes first. So there's no equity appreciation or anything you would need to contribute. It's just whatever amount it is on day one is going to be the same amount in year 30, okay? And in addition to that silent second or that deferred second, you can receive a gift of up to 2% of your first mortgage loan amount. And the gift portion of the assistance is not repayable. You never pay it back. It's immediately forgiven after close of escrow. It is subject to market availability, which basically means the amount of gift available fluctuates based on what's happening in the market and with interest rates. So I'm going to speak more on that in just a bit. But basically, we set the interest rates for the program, and the interest rates are typically at or below market. And the more assistance you receive, the higher the interest rate you will pay is on your first mortgage, right? And so you want to make sure you're discussing with your lender what is reasonable and affordable for you, because not everybody's going to need the full 5.5%, because again, that assistance is going to increase at the same rate the interest rate increases. And so again, you want to make sure you're level there and that it makes sense. So in terms of occupancy and property guidelines, again, you can purchase a home or refinance a primary residence anywhere in the state of California. Again, as long as it's owner occupied. You can also purchase a home up to 4 units using this program, as long as you occupy the property as at least one of those units as your primary residence. And if you're unfamiliar with the term units, it just means more dwelling space, right? So for example, a 2-unit property is a duplex, right? So the more units, the more families that dwelling can house. A triplex, right? That's 3 different units, right? So you can potentially put 3 families in a triplex. And then the quadruplex, et cetera, that's going to be the 4-plex. And so again, as long as you occupy at least one of those units as your primary residence, you have the liberty to rent the rest of those out. And you can actually buy that kind of property through this program. We also allow condos, PUDs, and manufactured housing. Okay, manufactured housing tends to be on the more affordable end, and then PUDs tend to be in those builder communities where you see a lot of the homes that look the same or have the same builder. Properties that we can't purchase using this program are going to be co-ops, investments, second and vacation homes. So keep that in mind. It does, again, have to be for your primary residence. And as I mentioned, GSFA sets the interest rates for the loans under this program. And you're only going to have an interest rate on your first mortgage. It's a 30-year fixed rate loan, okay? For government loans, we have FHA, VA, USDA, and HUD 184 loans. And HUD 184 loans allow federally recognized tribe members to purchase a home on tribal land. And if you're using a government loan, you'll be limited to a purchase transaction only. And then we have a conventional loan option available through Freddie Mac, HFA Advantage, and that's where you have the option of a purchase or a refi. And we have experts like Nathan with Change Mortgage who are going to explain what these loan options mean, what's available to you, and what's going to be the best situation in terms of your loan type for your transaction. The max first mortgage loan amount is $832,750. The only time you can't go to that amount is if the mortgage loan maximum is lower for the kind of loan that you're doing based on the county that you are purchasing in. So different loan types have different loan limits. And if that loan limit is lower than ours, then you would have to defer to that lower limit. And again, that's what Nathan is here for, to explain those variables to you. Now, even though we do have that max first mortgage loan amount, we do not have a max purchase price limit. So as long as you can afford to cover the difference between whatever the first mortgage loan amount and the assistance won't cover, you're free to purchase a home for whatever price you'd like. So when it comes to the credit score and debt to income ratio requirements, you need a minimum 640 credit score, okay, to get into this program. HUD 184 does have a 660 minimum credit score requirement. Again, that's the one for tribal land home purchases. And then the max debt to income ratio. And then for those of you who are not familiar with what a debt to income ratio, or DTI, is, it's simply the metric the lender uses to measure your expenses, right? Your debts against your income, your gross monthly income. And so there's a ratio that your expenses or your debts and your income need to be within in order to qualify for a home loan. And so for FHA and VA, as well as USDA government loans, 50% is going to be the max debt to income ratio, but you do have to have a 680 or higher in order to reach that threshold. If your credit score is below 680, your max debt to income ratio would be 45% using those loan types. HUD 81 or HUD 184 has a 43% max debt to income ratio, and then manufactured home on both government and conventional loans maxes out at 45%. On conventional loans, you can go up to 50% on the debt to income ratio, even with a 640 credit score. And then with 3 to 4 unit properties, your max DTI is going to be 45% if your credit score is below 680. So again, more information on income limits. This is a popular question we get on the program. People want to know, what's the income limit? Do I make enough? Do I make too much? Right? So first and foremost, with FHA and VA loans, there is no income limit. And I will say that the income limit is driven by loan type on this program. So with FHA and VA, there are no income limits. USDA loans have income limits, and they're set by USDA, and those income limits would be specific to wherever you're purchasing and also specific to USDA. So again, your lender would need to research that for you and let you know if that's the kind of loan you want to use. And then conventional loans, we do have income limits, and those are on our website, and they're actually very reasonable for both for all 3 counties near Humboldt. We've got Humboldt, Del Norte, as well as Mendocino counties at $196,560. And these income limits go up every year, but they're usually way more than what people expect them to be, right? So 80% of AMI is what, and AMI stands for area median income, is usually the threshold people think they have to be at in order to qualify for a down payment assistance program. And while that is true for a lot of programs, it doesn't apply to the GSFA Assist to Own program. But folks who are at 80% of the AMI or below are going to get, in most cases, a lower interest rate as well as more assistance from this program if they are using a conventional loan. Again, because conventional loans are the only loans where these income limits and the 80% AMI thing comes into play. Mortgage insurance is also cheaper if you are at or below 80% on your conventional loan. And by 80%, I mean AMI, okay? So how to get started? You want to reach out to one of our participating lenders. They have been approved by GSFA to offer the program. Participating lenders have been through the training, right? So they understand the program. They've done these loans before, so they know how they work. They know how to set expectations with you. They're going to take you through the entire process. So there's no point at all where you'll be working directly with GSFA. I think I've received a couple of emails with people reaching out and wanting to know, what we need from them. And what we need from you is to get with one of our participating lenders so they can explain the process and take you through the program. They're going to explain the guidelines to you, the interest rates, the APRs, and then again, help you determine what option is going to be the best fit. They process the application for you as well as your loan, your entire loan transaction. And we have your county resource website, right? Link there. I'm going to be providing a copy of the slides to everyone who's in attendance today. And you'll be able to access that website. I'm pretty sure most of you probably already have access to it, but it'll always be available as well as the recording from the training today for you to refer back to if you need. My team is available Monday through Friday, 8 to 5 p.m. Pacific, toll free and by email for any questions that you have. Now, as I touched on before, everybody's going to have a different reason for not being ready to purchase a home today, okay? But if your reason is simply you don't have the money for down payment or you don't feel comfortable spending the money for down payment, then this program could be the difference between you being a homeowner or continuing to pay someone else's mortgage as a renter. And so what we have here is this example of what the opportunity cost is of waiting. I'm sure we all remember 2020 and 2021 when rates were 2 and 3%, right? And everybody was, gung-ho, right? The housing market was crazy. But at the same time, there were still those people sitting on the sidelines saying, nope, don't trust it. We're just going to see what happens with the market. If you're one of those wait and see what happens people, you're probably looking at the rates right now saying, dang, I should have done it back in 2020 or 2021 or whenever my chance was. And now you're sitting on the sidelines again, waiting for the next change. And the reality is we don't know what's going to happen, right? All we can do is make the most of now. And when we don't, there is an opportunity cost associated with that. So again, taking that $415,000 purchase price and your 3.5% down payment that you need if you use FHA, you're going to say, I want to just save my money right now and just see what happens. I'll just save up for the down payment and just wait and see. Okay. You're going to save up that $22,411. Let's say you set aside $400 a month to do that. It's going to take you over 4 years to do that. And who knows what the market's going to look like in 4 years, right? 4 years ago, the market didn't look like what it looks like today. Okay. Now, in that same 4-year period, you could have accumulated over $100,000 in equity, right, in value in the property you purchased today, right? So this is almost 5 times more than what you were trying to save. You would have accumulated that just in the value of owning your home 4 years ago instead of waiting 4 years later. Okay. So again, these are the kinds of evaluations and conversations we want to be having with ourselves, our friends, our family members, et cetera, when it comes to when is the right time. And you don't have to take my word for it. We do have a series on our YouTube channel called Journey to Homeownership, and it's a video series that chronicles the experience that real people have had using our program. So I encourage you to check that out if you're looking for a little bit more assurance or you want to know, what is it actually like for somebody who's been through this. I encourage you to check out that series. And once again, I want to thank everybody for your time and interest today. If you have any questions, feel free to go ahead and drop those questions in the Q&A box on the webinar toolbar. At this time, I'm going to open it up to Nathan, if he would like to say a few words about his experience with the program, as well as what he can offer you as a participating lender. Nathan?
There, got unmuted. Took me a second. Yeah, thanks for having me, Megan, and everybody. The GSFA program is something that's truly special. Like Megan touched on, the one of the hardest parts of homeownership is coming up with a down payment, and that's what this program solves for. And between how we structure it, how we use this program, and how we structure your offer. We've been able to get in people with very limited funds out of pocket, and don't hesitate to reach out, even if you're not ready yet, because we will get you ready. If that's really your goal, if there's something that's holding you back, whether it's credit or whatever it is, we can assist and we can get you on a plan and get you ready. And I've worked with people 3+ years, and ultimately we got them into a home. So whether it's me or another lender, if you are interested, don't wait. Get started. Let's see if there's any hurdles to take care of. And if not, we'll get you ready and come up with a plan for you.
Awesome, awesome, and fabulous advice. Thank you, Nathan. I'm going to hop into the Q&A now and see if we have any questions we can get answered for you. First question, what if we have funds from selling our first home? Can that be combined with the down payment assistance? Yes, absolutely. Like I mentioned before, there's no minimum or maximum requirement on your end. If you do have your own money, you're more than welcome to contribute it to the transaction. That's just going to reduce your mortgage debt over upfront, as well as what you pay back over time. Next question, will the slides be shared with us? Absolutely. Everyone on the call today will receive a copy of the slides. I'll be sending those out within about 1 to 2 business days of our call ending. Next question. I have a question in the form of a hypothetical. Say I bought a multi-unit property and lived there as my main residence for a couple of years. After a while, I decide to move, but keep the property. What does the payback look like at that point? So with this program, there is no owner occupancy restrictive covenant, meaning that there's not a minimum, or I'm sorry, there is a minimum amount of time. You have to live there for at least 1 year as your primary residence. After 2 years, what you decide to do is entirely your prerogative. So, when you're purchasing an owner-occupied property, whether it's through this program or any other ordinary mortgage loan, the expectation and the requirement is that you do live there as your primary residence for the first year. If you decide to move out after a couple of years, that's perfectly fine. There's not going to be any repayment of the assistance required. Next question, can you remind us when the down payment is needing to be paid back? So the 3.5% portion, right? That's the second mortgage portion, that silent second. You're going to pay that back whenever you sell your property, if you refinance your property, right? Or if you, or in 30 years when the first mortgage matures. So in any event where the first mortgage loan is paid off, that's when that second becomes due and payable. The gift portion of the assistance never has to be paid back. Next question, does the program ever run out of money? No, it is an ongoing source of funding, so there's no deadline to apply or any timeline to use the program. Next question, is there somewhere we can easily find a list of local participating lenders? So yeah, our website, gsfahome.org, which is right here on your screen, is going to have a tab that says find a participating lender. And in fact, I think we can walk through that now. Now, before we get there, I do want to make sure everyone understands your lender does not have to be local per se in order to assist you with this program. The vast majority of what you're going to be doing throughout the lending process is virtual. However, you may have a circumstance that it makes more sense for you to work with a local lender. But I want to emphasize that it is more important for you to work with a lender who's knowledgeable and experienced and provides excellent customer service. Okay, that's what you're looking for. So this is the homepage of our website. You would simply go to business resources. Okay, actually, you don't even have to do that. Right here. Oh, no, never mind. Just kidding. Scratch what I said. We have a lot of programs. Okay, so but basically what you're going to do is right here where it says find a lender, after you hover on business resources, you're going to click participating lenders. Okay. And then it's going to bring up a list of all of our lenders. Okay. It's going to have GSFA Platinum and Golden Opportunities, and an X will be marked under which program that lender is participating in. You want to make sure you're reaching out to lenders who have the X under GSFA Platinum, because that's where the Assist to Own program is available, or product, I should say, is available. It's under the Platinum program. So if they have an X marked next to or marked under GSFA Platinum, that means they're participating in the program. Now, one thing to note is not every person or loan officer who works at that company is familiar with the program. So when you call, it's important to ask for someone who has experience with the GSFA Platinum program. Okay, and if you want to get even more granular, you can ask for the GSFA Platinum Assist to Own program. Okay, if you want to narrow down your search, because this is a pretty long list, just click on branch locations by county. Pick a county from the drop-down box. You can click Humboldt, and then you've got a few lenders here. Now, the only limitation here is it doesn't tell you if they are platinum lenders or not. So you would actually have to call these branches and ask, okay? And like I said, I just want to point out that it's not important for you to work with someone locally in most situations when it comes to your lender. Your realtor, yes. Your loan officer, not so much. That's more negotiable. We also have a top loan officers list, and this is going to give you a list of the folks who do the most GSFA loans. So I encourage you, Angela Parrish works in Nate's office, and she's very experienced as well. And she can also help along with any of the other loan officers that are listed here. So I encourage you guys to just do your due diligence and your homework, especially when it comes to finding a participating lender, because this is a big deal, right? This purchase is a lifetime, a life altering experience, and you want to make sure you're in good hands. Next question. If both myself and my partner work for the county, would we apply for the down payment assistance together? And if so, does that change what we're eligible for at all? No, it doesn't. And no, you don't. You have the option to apply together, but it's not required. Only one person has to be a Humboldt County employee to be eligible for the program, right? So if your spouse or your partner or whoever wants to go on the transaction or the application with you, they don't have to be a Humboldt County employee, but you do. And you also need to be the one who's going to live in the property, right? So it can't be like, oh, I want to help my son buy a home, so I'm going to go on the loan with him, but I'm not going to live there. Can't do that, okay? You want to make sure your intention is to live in the property that you purchased through this program. And no, it does not change the assistance at all. The assistance is what it is for each application. Next question, do student loans count in the debt to income ratio for GSFA? Nathan, did you want to chime in on that?
Yeah, so for the most part, student loans do. A lot of times when we'll pull your credit report, it will show zero payment if they're deferred. But we have a ratio to include them on, and it depends on the loan program, and it depends on if they're going to be deferred later or forgiven, depending on, there's so many situations. So again, that's why getting connected with that lender early to find out if how that could potentially impact that DTI is really important.
Excellent. And to add to that, GSFA doesn't have any specific requirements around student loans. We defer to the loan type. And so that's where experts like Nathan and other participating lenders can help guide you through what the requirements are around that. Next question, any way to find a 4.5% 30-year fixed rate mortgage? Nate, any insight on that?
Um, on a traditional loan program, you can get that rate, but the amount that it's going to cost you to get that rate would not help. The amount of money would be better put towards your down payment. That would have a bigger impact than buying down the rate to that level. So right now, 4.5% is not really happening. GSFA has very aggressive rates. We use their program on top of all the other benefits, but also because of how aggressive their rates are. But right now, 4.5% is it's not very affordable. We'll put it that way.
Great answer. Thank you, Nathan. Next question. I didn't see Nathan's contact information. Can we get an email? Nathan, can you type that into the chat, please?
I sent you a little message for some reason. I don't know if it's my access. It's not letting me add anything to the
Okay.
chat. It only lets me direct message you. So I sent you a message with everything. I don't know if you could add that to the general
I'll
chat.
take care of that. Okay, so I just popped Nathan's phone number and email into the chat. So if you click on that, you should be able to see it. Let me know if you don't, and we can find another solution if that's the case. And if you have any questions, make sure you click on the Q&A icon and type in your question, and I'll see it there. Question, Humboldt County website says this is the waiting list for first-time homebuyer loans is currently closed, but we are actively pursuing funding to continue the program. Is that accurate? So if that is accurate, it doesn't apply to this program because number one, our program is not a first-time homebuyer program. Of course, first-time homebuyers are welcome to use it, but it's not exclusively to first-time homebuyers. Also, there's no wait list for this program as well. So that's probably referring to a different program.
Yeah, Megan, my guess would be Humboldt probably has a specific first-time homebuyer program that currently doesn't have funds. That's not GSFA.
Yes, and I see Jessica nodding her head, so I'm assuming that's correct. Jessica, is there anything you wanted to add to that?
I believe the program that the person is asking about is through County of Humboldt Planning and Building, but I'm not positive.
Okay. Okay. Well, most importantly, it's not applicable to this program. Okay. So thank you for that question. Next question. Will the down payment assistance change anything with the pre-approval odds? Nate, did you want to chime in on that?
I'm sorry, what was the question again? I didn't see it.
Will the down payment assistance change anything with the pre-approval odds?
With the pre-approval odds, ultimately we look at three buckets and it's, credit, income, and down payment. So it does help your odds because now, depending on your situation, we have a down payment, to work with and to adjust the numbers with. So I think it could benefit you having that, but it's not going to make the odds worse. It's only going to put it better in your favor. But at the end of the day, applying for a loan, whether it's GSFA through an FHA or a conventional loan, or just those loans on their own, it's those are the three main buckets that we look at: credit, down payment, and income. So we know you work, you've got a great job there with the county. And then what we're then taking a look at is how that impacts your debt to income. And the whole scenario is a snapshot of where you're at right now. So there's so many, it's hard to be, sometimes we want to have very specific answers, but there's so much that is taken into consideration when we're looking at a loan approval that it's hard to be overly specific because we look at your overall, like I said, those big buckets and where you're at with some different things.
Awesome. Thank you, Nathan. Next question, can we have the lender's contact info? So I did type that into the chat. His phone number is 530-518-1043. Again, 530-518-1043. And then his email address is in the chat as well. Next question, curious if we could understand what the mortgage cost may be after a house is purchased. Is it higher than the standard rent, $1,500 a month? Nathan, sounds like a you question.
Yeah, so what goes into your house payment is a couple of things. So you've got the principal and interest portion of it that's repaying your actual loan. Then you have property taxes due to the county. You have homeowners insurance. And then unless you have 20% down, you have something called PMI or mortgage insurance. There's a couple different names for it. And so would it be standard about $1,500 a month? That's going to really depend on the sales price, the interest rate at the time, if you have any additional funds down. But on average, it just depends on the area if mortgage is higher than rent. But on average, the minimum payment is going to be usually a little bit higher on a mortgage. But a story that I tell all the time is I remember meeting with a gentleman years ago, and he was telling me about how he had owned a home for the past, I think it was like over 50 years. And he was talking about how difficult it was. They bought it when they first got married and how they had to struggle for the first couple of years to make that payment and how hard it was. And he was like, do you want to know what that payment was? and it was like $300 a month.
Wow.
You know, and that's the difference with the mortgage and rent is your mortgage is going to stay the same, and you're going to build equity on that property. So even if you do have to kind of push it a little bit, obviously we don't want to set you up for to fail. We want to set you up to win. So we're not going to put you into a loan that you can't afford. And there's guideline, you know, about to keep that from happening. But ultimately, you're building equity. It's your home. That mortgage payment does not go up. Whereas rent, you know, usually goes up yearly unless you got a really nice landlord. But it keeps going up, and you know, this is the highest your payment is going to go for the next 30 years. And if rates get better and we refinance you and we get you into a better rate, great, and a lower payment. But if not, you know, I have this payment locked in. It's never going to go up. And that's just such a great feeling.
Definitely. Thank you, Nathan. Next question. Second question. I married my husband who owns the home we live in. I'm not on the title. If I want to buy a home for my future stability in the event of his death, am I qualified to buy a home as long as we live in it as our primary? Yeah. So again, even if you were on title, that wouldn't be an issue. The main point is that you live in the home that you purchased through this program. So as long as you live there as your primary residence, right? It's fine. It doesn't matter if your husband owns the home, if you're on title, if you're not on title. You just need to make sure whatever home you purchase through this program, you intend to live there. Next question. I need to improve my credit score and pay down my outstanding debts, credit cards, etc. before I feel ready to start trying to buy a home. How can the lenders help me plan for this?
So initially, when we meet, you know, virtually or over the phone or however we do it, Zoom, we'll send you an online application, and part of that is we'll do a soft pull, and so it's not going to impact your credit, but we'll take a look at where your credit's at right now, and then we come up with a plan because there is a way to attack credit card debt. A lot of times we tend to put a little bit extra on a whole lot of cards, and you know, we take a look at everything, but a lot of times it's better just to focus on one and get it paid down to a certain area. And then also the credit company that we use to pull your credit, you know, we can tell them what the score is that we need, and it will give us a plan of, okay, if you get your debt paid down to here, then this is where the score will be. So that's part of that initial consultation, is taking a look at where your credit is and getting you ready. And then from there, it's usually time. You know, credit is a big equation, algorithm, and depending on the information you're dumping into it, it deems the score it kicks out. But if you've got some bad information in there, whether it's, you know, too much debt or late payments or whatever, it could take a while of getting the good information pumped into there to where your score starts to move. But you know, like I said, we've worked with people over 3 years. We get them ready. We go through all of that, and we put you on a plan. And then, you know, if you execute that, we'll get you ready to purchase.
Awesome. Thank you, Nathan. And again, that's one of the things that differentiates a good lender from a great lender, right? Because a great lender is going to take the time and have the patience to walk you through what needs to be done to optimize your situation, right? They're not just there to make a quick buck and dash. They're genuinely there to support you and provide that help that you need to make your home ownership dream a reality. Next question. When is the DPA due? Is it due in full or installments? So again, it's due whenever the first mortgage loan is paid off. So whether that's through a refinance, through selling your home, or through 30 years, when you make that last payment on your original mortgage, that's when the second mortgage portion would be due and payable, and it is due in full. So if you were to refinance, more than likely, you would probably use the equity from your home to pay off that second in that case. Next question, can you buy a fixer-upper with this assistance, or does it need to be move-in ready? So there are some loan types out there that will provide you with rehab funds in order to make improvements to the property. It depends on how much of a fixer-upper it is. Our program does allow for an FHA streamlined 203K, which I believe allows up to $50,000 in repairs. So that's going to help with a property that needs like minor to slightly moderate repairs or fixing. There's also an energy efficient mortgage offered by FHA, which allows you to make energy efficient improvements to the property. But if it's like a dump that needs a full rehab and at least, over $50,000 in repairs, then we wouldn't have a loan type through this program that would support that. But again, you can connect with Nathan. If that's your goal, that's what you want to do. Nathan has access to other loan products and options that could help you with that process. Next question, would you mind recommending a video like this webinar to show my other half? Thank you. Well, this video will be available, so you're welcome to share it with your other half. I have no objection to that. In fact, I encourage it. Next question. I have a question about the 3.5% repayment. If the amount isn't paid back within 30 years, will interest be added? And if so, how much? Also, when repayment is due, is the full amount required immediately, or is there an option to set up a payment plan? So the second mortgage is a lien, right? So in 30 years, let's say that's how long it takes you to pay off the first mortgage for whatever reason, right? That's when that second mortgage will be due and payable in full, right? So there's no payment plan available for that. It's a lien. So if you don't pay it in full, the foreclosure process will start. Okay. And you obviously don't want to be in that situation, but it's not like, just a handshake. It is a lien that your property will be repossessed if it's not paid as agreed to. Okay, next question. What are concerns to spot for bad lender versus good lender? Nathan, do you have any insight on that?
That's a great question. Just general knowledge of the program, making sure that they've actually closed one before or aware of it before. So a lot of lenders will say they have access to it or they know how to do a down payment assistance program, but do they actually close them? So that's a very big difference. So a lot of lenders don't like down payment assistance loans because they do require more time, and they're a little bit harder on behind the scenes for the lender. And there's just more that goes into it. But when you talk to them, you can tell pretty quick if they have the passion for doing a down payment assistance loan, and that goes into it and what it does for their community. So that's the big one. And then from there, looking at reviews, looking at social media, you'll get a pretty good idea if this is somebody that you want to work with. I know this isn't just a first-time homebuyer program, but I think the advice is the same. You want to build a team. And so whether it's a lender, the realtor, you want to make sure that you're feeling very comfortable with the advice that they're giving you. We do this, 15, 20 times a month. You're going to buy, maybe 2 or 3 houses your whole life. And so you want to make sure you're with a really good realtor that you trust, that you appreciate their advice and you like their advice. And same with the lender. If after we meet, you decide to give me a call and you don't feel comfortable, then it's better to find another lender, because ultimately by working with me, you're hiring me. By working with the realtor, you're hiring the realtor, and you want to make sure they're working for you. So I think just some general questions about their process, how they handle first-time home buyers. Are they going to educate you? If, that first meeting, they just kind of brush you off or say, no, you don't want down payment assistance. We're going to do it this way without explaining it. Those are all kind of like some red flags that would be that I would take note of.
Great. Thank you, Nathan. And then just to add to that, piggybacking on what Nathan was saying, communication is the key, right? I mean, with any good relationship, strong communication has to be there. Having a lender that is responsive to your questions and concerns and is, making you feel prioritized in the transaction through, answering questions honestly. If they can't answer it, letting you know they'll get back to you and actually do get back to you, right? You want to feel like they actually care about your situation. Another thing you want to look out for is if you ask to be placed in this program and they say, oh, yeah, okay. And then they immediately try to switch you to something else, right? If they tell you you can't qualify for this program, you need the why, right? Ask for why not. Okay. And if they can't give you a viable explanation that actually makes sense and is legitimate, then you might be working with someone who doesn't have your best interest at heart. Okay. So just a couple things to keep in mind. Thank you for that sage advice, Nathan. Next question, does the other homeowner's income count towards the income limitation? So it depends on if you're in a loan that has an income limit, right? Because not all of the loan types under our program have an income limit. And B, are they going on the loan application? If they're going on the loan application, it's at the lender's discretion, depending on what your scenario is, to use what income matters, right? So for example, with a USDA loan, they look at household income. So they don't care who's going on the loan or who's not going on the loan. They care about if you're an adult, 18 or over, living in the home and you have an income, your income counts towards the limit. However, if you were using a conventional loan like Freddie Mac under our program, the lender has discretion. They can use whatever income makes the most sense for the transaction. So it's limited to the income that's actually going on the application. If you have a spouse, they're full-time employees, and you are too, and it just, you don't need to add the spouse's income to the application to make it work. The lender has the discretion to exclude that income from the application. So again, that's definitely going to be a case by case depending on the loan type and your individual situation, what kind of income you need. But any income used to qualify on the loan application will count towards the income limit. Next question, does medical debt count in the debt to income ratio? Nathan, do you want to answer that one?
Medical debt, if it's on your credit report, then it depends on if it's being shown as a collection or if it's what's that called, like a care card. So usually yes, but also there's some cases where it's a no. It's one of those case by case situations depending on how the credit report looks.
Yeah. Next question. Will a bankruptcy 3.5 years ago ruin my chances?
No. So for it depends on what chapter of bankruptcy you filed, the reason for the bankruptcy, and so we take all that, the guidelines take all that into account, and then then we can usually make something happen. But just know one of the big things, if that is your situation, is to get the discharge paperwork, because we need to know the exact date that it was discharged. By discharged, completed, once it was all wrapped up, the court signed off on it.
Thank you. Next question. What does aggressive rates mean in numbers?
GSFA sets their own rate, but traditionally I'm trying to think of if there's an actual like BIP difference between the two. It could be anywhere from an eighth to a quarter to 3/8. I've seen it better. It just depends, pricing, mortgage, without getting way out there, but mortgage rates are set by the bond market and mortgage-backed securities. So rates were moving in a very positive direction. Then the situation in Iran started happening and inflation is triggered to the oil, so rates jump back up. So it's so much dependent on like I said, the bond market really drives rates. But what is nice with GSFA, if other lenders are increasing their rates, they are usually a lot slower to increase their rate, and it doesn't increase as much as maybe another lender does. So it just gives us some flexibility there and some more stability. Whereas with with a regular kind of lender, it can change. It changes every day, but sometimes it could change 2 or 3 times in a day if the market's going really bad. So we just have a little bit more stability with GSFA, and on average, the rate is lower, but it depends again on the situation of if you're under the AMI limits and what kind of program you are using.
Yeah, great answer, Nate. And to his point earlier, even if you, because GSFA sets their own interest rates and they're usually at or below market, it could make it to where you can use the program just for the rate. So if you're not someone who needs down payment or closing cost assistance, but you want a more affordable interest rate on your mortgage loan, your lender has the option of putting you in the program just using the rate without any assistance at all for down payment or closing costs. Next question, what are the average rates they're using? Interest rate and APR is very important to know.
So the APR there's a lot of APR fees that go into the closing costs. So to quote you an APR, I can't do that until we plug all the information in. And to be honest, I haven't even looked at your rate today, Megan. And their rate too, but so you guys understand, on their program, it depends on how much assistance you have. So the three, if it's a conventional loan, it's 3%. That's one rate. If it's an FHA loan with 3.5, that could be different. And then on top of that, the more assistance that you use. So if it goes from 3.5 to that 5, well, that's going to be a different rate. So again, it depends on the program that you use, the amount of assistance that you use, and then the total fees involved with that transaction, which would drive the APR. But you give me a second here, I could take a look at what the general rate is for today. Megan, I can hop back on if you want to answer a couple more while I look at that rate.
Yeah, and to Nathan's last comment about for today, that's really important because the interest rates can move from one day to the next. So timing is also another factor in what the interest rate and APR will be. Next question, is it impossible to use this for home improvement loans and also to buy a manufactured home to put on an existing property? Yes, it is, because the only way you can use this program for home improvements is if it's through an FHA energy efficient mortgage or an FHA 203K streamline, right? If you want to refi your house because you already own one and take out equity to do home improvements, we don't have a program for that. We also don't have a program where you can build a home or place a home on land. For manufactured home, it already needs to be assembled and affixed to a permanent foundation in order for you to use this program to finance an already completed manufactured home, completed install, the whole shebang. Next question, how much is the down payment assistance again? So it goes up to a maximum of 5.5% of the first mortgage loan amount. 3.5% of that is going to be a silent second mortgage on a government loan, and 3% on a conventional loan is going to be a silent second. And again, a silent second is just a second mortgage with no monthly payment, no interest. It's simply going to be due and payable whenever you refinance or in 30 years, whenever the first mortgage matures, or if you sell the property, you would have to pay off that second mortgage. The gift portion on top of the 3 or 3.5% second is not repayable, and it maxes out at 2% depending on where things are in the market. But once it's locked in, right? So you don't have to worry about your assistance changing after it's been officially reserved by your lender. It's just the fluctuation that happens in the market before you lock it that can impact what your interest rate and assistance amount will be. Next question, is this a separate company from the company we have to go through, such as FHA, VA, USDA, Freddie Mac, or is it all done through the same lender? So everything happens with the lender. So you're going to get with your lender, they're going to provide you with FHA, VA, USDA, or Freddie Mac and this program, right? All in one package. So you don't have to deal with multiple people regarding that. So it's all going to be one-stop shop with Nathan or one of our other participating lenders. Question, for the married person who's not on the title of the husband's home, please share this info. You can also purchase a home under the title, a married woman on the title of sole and separate property. Yeah, so if you wanted to purchase your home, independent of your husband, and it's your primary residence, or maybe you want to purchase an investment property, not through this program, but you always have the option of taking title as a married woman, sole and separate. So your husband doesn't have any ownership interest in that, and your title company and your lender can explain what the process is on that, what documents they need to sign. Next question, I'm not 100% on the multi-unit options. Does this mean one could buy up to a 4-unit property like a townhouse and have a domicile of up to 3 rentals? No. What it means is you can buy a duplex, a triplex, or a fourplex, right? So basically a dwelling that can house multiple families through 2 to 4 front doors, right? So like a duplex, for example, has 2 front doors, right? Because one side is for one family and a front door, the other side with the front door is for the other family. So that's going to be a 2-unit property. You cannot buy a townhome and have 3 rentals financed through the program. That's not how it works. You can buy a townhome as your primary residence. If it's an attached townhome, it's going to have other units, but the townhome would be exclusive to you and your ownership. You wouldn't be buying other units in that townhome community, if that makes sense. Hope that helps. Next question. What are the average interest rates that they are using? Interest rate and APR is very important to know. That sounds like a duplicate question. I know Nathan was researching that. Next question. Oh, Nathan, were you ready to chime in on that?
Yeah, so like today, through a website called Mortgage News Daily, they're showing today's average rate for a conventional 30-year fixed rate mortgage is, and it doesn't say what the points and fees are, it just says the average rate that was locked in is 6.62. 6.62, yeah.
Okay.
Today, for the average rate, or the rate for the assist-to-own program on a conventional loan today, with the 3% of assistance, and would be, where are we at here? Hold on, 6.5. So the rate's a little bit better, but on top of that, you're getting 3% assistance. And if you wanted to increase the assistance, that rate could go up all the way up to, an additional 4, a total of 4.5. So you're starting off with a better rate and getting a 3% gift or assistance as well.
Perfect. Thank you, Nathan. And I want to remind everybody that these rates do fluctuate, right? They can change with time, the market, everything that's going on in the, bond market and whatnot right now as well. So just keep that in mind. Also, we are unfortunately out of time. I don't want to take up any more of your lunch than we already have, but I do want to thank everybody for your interest and commitment to your journey. For the remaining questions we have in the chat, you're welcome to reach out to myself or Nathan, right? Especially if it's a loan specific question or individual, right, question. I highly encourage you to reach out to Nathan or one of our other participating lenders who can help answer those more granular questions for you. With that, I will again want to thank everybody for your time and interest. We wish you the best of luck on your homeownership journey. Take care.